everyone. Welcome. My name is Leah Voigt, and I work for Metropolitan Family Service, where I do credit coaching with business owners. In our last video, we talked about how you might know if your business is ready for credit building. And in this video, we'll learn about different options available for building business credit. This presentation was made possible by Prosper Portland and presents information that was created by the Credit Builders Alliance. So, at Metropolitan Family Service, our vision is a world where children never go hungry, young people are always educated, families are financially stable, older adults remain connected, and everyone is healthy, happy, and cared for. You can learn more about how we do this work at mfspdx.org. As I said, this information is created by Credit Builders Alliance. So CBA's mission is bridging the gap between equity-focused nonprofits and credit bureaus to unlock credit as an asset for all. And the content in this training should not be construed as and doesn't constitute legal advice on any specific matter. This information is also provided without any representation that it's complete. It's not an endorsement of specific products, lenders, or even credit builder strategies. You should carefully consider any product or strategy before entering into an agreement or pursuing it. So you've watched the last video, or in another way, you've decided that your business is ready to focus on building credit. You've consulted with your advisor, you've gotten legal guidance, gathered all of your documents. So what type of credit products are available for small businesses, and how does credit building actually happen? Building credit of business or personal credit is a process. It's something that takes time. It's something that really starts with getting documentation, getting records of your business's borrowing and repayment habits. So that can only happen if your credit product is being reported to one of the major business credit bureaus. Many lenders, vendors, and other creditors decide not to report. It's totally optional. And so that's up to them. Reporting and all of the requirements to get there can take time and money, and not all lenders want to invest in this. So what does that mean for your business? If your business is focused on building credit, the credit product that you take out as part of this process needs to be one that's getting reported to credit bureaus. There needs to be something that's helping you create that record, those documents on paper showing your lending and repayment habits. If it's not reported, it can help your business, but it won't help your business credit. There's a lot of products, right? It might be the right fit for you and your business. In terms of financials, that's great, go for it, but just know that it's not going to be building credit, and know that especially as you're starting out, the products that are helping you build business credit might not be meeting all the financial needs of your business. You want to find one that does do both, but also being aware that it's laying a foundation, doing this step now, getting that record established now, so that later when you do want to borrow, your business does want to borrow larger sums of money, that it has that established, that it does repay lenders, and so that then you can qualify for the financing that you need and hopefully get lower interests, better terms. The other thing that happens often with small businesses is that lenders may report the credit, but they might report it to the consumer or individual credit bureaus rather than the business credit bureaus. If you're working on building your personal credit, that can work. That can be part of that credit strategy. But if you're specifically working to build business credit, asking the lender you're working with, making sure the credit product that you're signing up for will be reporting as business credit to the business credit bureaus. It can be a lot of work and research to make sure that you're finding the right credit product that meets your business's financial needs and goals, as well as credit building goals. And investing that time and energy now can really pay off for where your business is going in the future and being able to meet those future goals, or setting yourself up for success in those future goals. Getting credit in your business's name can also provide additional opportunities for building up relationships with vendors and creditors and other business credit products down the road. So the credit products that your business qualifies for, as well as the credit products your business needs, can change over time. Building credit does not happen overnight. It takes time and it takes taking the steps, preparing, and it can help both with unexpected and expected needs and events. So, for example, if your business is looking for a new space, looking for a new lease because you've outgrown your current space, if it's looking at purchasing new equipment, um, that can be something that involves credit. A lot of people don't have the cash to do that, especially if they're looking at long-term payoff. And then also responding to natural disasters or other short-term slow periods in business, having credit available to your business can help weather those difficult times and get you on your way to staying active and helping your business achieve its long-term goals. So, how does a business build credit? There are similarities to personal credit and also important differences. To build credit, a business needs to have open, active credit accounts. Ideally, these are paid on time and they need to be reported to at least one business credit bureau. These accounts are also called trade lines. Just if you hear that name come up later or just in general as you're doing your research, that's another way that they're referred to. Trade lines show products your business has taken out. These can come from banks, credit unions, nonprofit lenders, and online lenders. They can also come from vendors, people or companies that offer something for sale, like construction materials, napkins, and utensils for a restaurant, or even a service like printing or shipping. Vendors are also sometimes called suppliers. And as we said, credit building takes time. The reason for this is that each month's payment after borrowing that money or starting that credit product is going to be reported. And because these are being reported 1 month at a time, that just takes time to add up and build that pattern, show that nice, stable, on time repayment that lenders want to see that are going to make getting future credit offers more likely for your business. You have options for building credit and for where to find credit products as well. Is that banks or credit unions can be really good starting points, especially if you already have an account with them. They often offer multiple different types of business products. Sometimes these can be either for larger dollar amounts or smaller dollar amounts that then make sense for your company, for your business. And so making sure that even though the goal is building business and getting something down at paper, that it's still a credit product that's going to serve your needs, that it's something that you're going to be and your business are going to be successful at repaying and will help further your business goals. Vendors or suppliers that offer a product or service, as we said, can offer them where they provide the product or service and then the business pays it back over time, right? Maybe a 30, 60, 90-day invoice. And those are extensions of credit because they're giving you a product and you're paying them back. So if they are reporting that, that can also be a way to establish credit. They may also have credit accounts, charge accounts with that vendor that you can open with your business that, again, if they're being reported, can help you build business credit in addition to helping you get the supplies and services that your business needs. A number of online lenders offer business products, especially credit cards and loans. Sometimes there's more flexibility or they're looking at a wider set of factors or a different set of factors that may be something that your business more easily qualifies for. One thing I encourage you is to always do your research. This is true for in-person or brick and mortar institutions as well as online. We just know that especially online, right, there can be a degree of separation of not having a physical branch you can walk into, check out, make sure that they're a legitimate business. So extra goes for working with online lenders is do your research, do your research, do your research. This also goes for making sure, in addition to the company, is an appropriate company is also that the credit product itself, making sure you read fine print, making sure that it's something, again, that you'll be able to borrow and repay that will serve the needs of your business, that it's not high cost, high interest, something that sounds good in the short term or sounds enticing because you can qualify for it, but will actually result in you having to pay back and your business having to pay back more money and really hurting it in the long run. Finally, there are local organizations in the Portland area, MISO, Craft 3, Prosper Portland, all have different business loan programs that support businesses. And there's also small business administration loans and intermediary lenders and community development financial institutions, or CDFIs, which are some of the ones that I just named earlier, that can provide loans and counseling services to small businesses, and are often set up in a way, because they are specially tailored towards helping those small businesses succeed, may have more flexibility in who they can offer loans to or the kind of information that is on an application. There still may be a more flexible or easier path to yes when working with those organizations. So we're going to look at 4 types of credit products that can potentially build business credit. These include business credit cards, vendor credit, business loans, and lines of credit. Not all credit products get reported, as we've talked about. So as you think about these options and do your research, there's both what's available and also how much does reporting and building business credit play into your choice. So business credit cards are similar to personal credit cards. They provide ongoing access to funds that your business can use as needed. Some are generic and can be used anywhere. Some are from specific stores or vendors like gas stations or office supply stores and can only be used at that specific store where the credit card was set up. Credit cards come with credit limits, which is the maximum amount that can be borrowed from or charged to that credit card at any given time, and also have minimum monthly payments required. So once you've borrowed money, a minimum amount that you'll need to be paying towards paying that off every month. Be aware that you will have to pay interest on the amount that is being carried over to the next month that hasn't been fully paid off from the month before. Banks and credit unions typically offer business credit cards. Some online lenders also offer them. And business cards work well for regular ongoing expenses like cleaning supplies, raw materials to take products, subscriptions, or licenses, and also can be helpful for emergency funds to help cover unexpected expenses. Another option is vendor credit, also known as trade or supplier credit. Vendors or suppliers, like office supply stores, printing companies, or wholesalers, allow you to purchase goods or services that you pay for later. There are 2 types of vendor credit. One is invoicing, where a supplier lets your business buy from them and issue an invoice. Payment is typically then due 15, 30, 60 days from delivery. I misquoted that earlier, my apologies. And depending on the vendor and what they agree to, they're basically extending short-term credit to your business. If you pay in advance or on time, you typically won't be charged interest or fees. And then there's also vendor financing. So a supplier provides more extensive, longer-term credit plans, but often charges interest and may have a rigorous application process. Smaller local vendors are sometimes easier to work with, especially if they know you personally or know your business well. Larger vendors like big box stores or chains might require more in-depth applications or have stricter qualification requirements. Smaller vendors aren't as likely to report to credit bureaus as larger vendors. Vendor credit can be a really good fit for your business when you're a new business or an existing business and want to create or continue building a long-term relationship with specific vendors. Can also be a really good fit if you need equipment, inventory, or supplies regularly and often in larger volumes. Business loans are another type of credit product option, and they're designed for specific uses like buying a building or a vehicle, funding startup costs for a new business, agriculture or farming improvements, or adding new jobs. They're paid out in the beginning, the full amount, and then paid back in monthly installments. Another reason they're called installment credit, that are equal amounts each month until the total amount of the amount you borrowed plus the interest is paid off over a certain number of months that are agreed on in advance. You can find loans at banks or credit unions. You can also find them from government agencies like the Small Business Association, US Department of Agriculture. You can also find them at CDFIs, local lenders such as Prosper Portland, Craft 3, MISO. Loans are beneficial for larger purchases that you want to pay off over time in installments. This could include things like property, vehicles, or construction costs. They can also help cover expenses like wages or basic operating costs for business with income that fluctuates during different times of the year. Businesses that do contract work can also use loans to cover the costs while they're waiting to be paid. They know that money is coming, but because they're not going to get paid until they finish the job or half in front and half at the end, depending on the contract, then they need money to cover the costs in the meantime. Loans can be a good option for that. A specific subgroup of loans are the federal government's Small Business Administration Support Loans Program. They're specifically intended to help new and small businesses start and grow. Here's how it works. The SBA provides funds to lenders for the specific purpose of making loans more affordable and easier to obtain. These loans come with lower interest rates and may not require collateral. They also generally have lower personal credit score requirements than traditional business loans, which can be really helpful. SBA lenders are usually banks, credit unions, or nonprofits. So your business applies for and takes out a loan directly with the lender, not the SBA, and makes payments to the lender. Many lenders also offer business coaching or assistance programs along with these loans. Lines of credit are another type of credit product. These have set limits like a credit card, but instead of charging expenses to the credit product, businesses take out cash as needed to pay for the expenses. So the cash can generally be used anywhere. Lines of credit require minimum monthly payments and can accrue interest if not paid in full. They can also come with late fees for missed payments or late payments. Lines of credits come with credit limits, but once the balance is paid, the credit will again become available. Lines of credit can be available for a few months through a few years, depending on the specific product and the lender. They can be extended or they can be closed out completely. Or a business might wish to reapply for a new line of credit, possibly with a different lender, with different terms, or with a different credit limit. Banks, credit unions, and nonprofit lenders tend to offer lines of credit, though some online lenders or even vendors may offer them. And I know that some of our local nonprofits and organizations work less in lines of credit. Lines of credit can be important for businesses with expected slow periods but heavy sales during other months. Product-based businesses that stock inventory like clothing or gift shops, or those that must regularly order raw material to make their own products, such as restaurants or manufacturers. Businesses with a quick turnaround period, meaning time between acquiring the inventory and selling it. These businesses use lines of credit cyclically, buying, selling, paying it off, then buying, selling, paying it off again. Every business has different needs, and product options will depend on your unique situation. Your personal credit may impact the rates and terms of available products. Where you are geographically and the different organizations that are working in that area might affect it as well. Before you take out any credit product, carefully read any contracts or agreements and make sure that you know the monthly payment amount and the terms and how this impacts your business budget, what the interest rate is, whether there are prepayment penalties or hidden fees, whether your product reports to the commercial or consumer or both credit bureaus. So again, business credit bureaus or personal credit bureaus, and ask when and where they report so that you know what to expect. Also, good to know who to contact if you should run into any trouble. There is in the Portland area an organization called Vibrant Futures and Robin Wang, and he has a one pager of information on things to know before signing a business credit contract. And that can be a really great resource to support this process as well. As you go on this process, think about your own business, its needs, and its goals. And of what we just talked about, which products could help meet your business's need? Where could you find them?
So now we're going to jump into some knowledge checks. Between the reading of the question and me giving the answer, I highly encourage you to pause, take a minute, think about what your answer is, see if you can come up with it on your own, and then go ahead and hit play on the video once you're ready to hear the answer revealed.
True or false, all business credit cards, loans, and lines of credit and vendor credit opportunities report to the business credit bureaus. The answer is false. Some products labeled business or issued to your business actually report to the personal credit bureaus, while some don't report at all. You think of one of the business credit products that we talked about today. They are credit cards, business loans, vendor credit, and lines of credit. Another knowledge check. What factors should you consider when evaluating credit products for your business? A, whether and where it reports. B, interest rates and other terms. C, whether the payment will fit into your budget. Or D, all of the above. The answer is D, all of the above. Well, it's important to know this information and whether a product will help your business's credit. It's also important to make sure that you can live with the rates and the terms, that it's something that's going to be affordable and support your business's financial picture and other goals as well. As we close out, here's a quick review about the best practices for strong business credit scores. Always pay on time and aim to keep the balances low. Pay the full amount whenever possible. When it's not, make sure you're at least paying the minimum balance and try and pay a bit more than the minimum balance, even if you can't pay the whole balance in full. If you can afford to pay early, do so. Establish multiple trade lines, right? The goal for credit building is to get documentation of your credit borrowing and repayment, but don't take out more credit than you need or that you can afford. You want to make sure that each step you take is building towards your goals and doing so in a way that's sustainable for your business. And give it time. Credit building takes time. They said it's building up that record and documentation. And the way to do that is doing it month after month, letting it get established on paper. 6 months is a really good time frame to aim for, and keep going from there.
We covered a lot of information today, and business finance is a really big topic, and running your business is a really big job. So I also want to share some additional resources. The FDIC Money Smart for Small Business materials might be beneficial if you more generally want to learn about different topics related to small business development and banking. You might also be interested in seeking out mentorship via SCORE's network of retired entrepreneurs and business leaders. And local and regional small business development centers can also be good resources for additional business advice and counseling. I've included the Oregon Small Business Development Center link on this slide. Other resources that might be helpful include the U.S. Small Business Administration. This is listed as the website for the Portland District. The Portland District in this case actually covers most of Oregon State, particularly the western side, and then the Oregon Office of Small Business Assistance and the Portland Small Business Hub.